On today's What Do We Do podcast, we're tackling a debate that's everywhere right now. Which will be the future of money? Dollars, gold, or crypto? Should you hold cash for payments? Maybe gold for safety? Or what about crypto for growth? Well, the real answer is yes. Yes, you should probably hold some of all three. The question isn't which one is right, it's actually how much of each you should have and how you should use them all together. Stick with me, I'll break down what each does best and how to size them smart in your portfolio, as well as the risks associated with them all too. It's gonna be a great show, so hit the subscribe button, give us a follow, and let's go. Welcome back to the What Do We Do podcast. I'm your host, Dewey Stephan, and I'm also the CEO and Chief Investment Officer at Great Lakes Wealth. Well, today we're asking a big question. What is the future of money? Is it the dollar bills in your wallet? Or maybe the gold sitting in a vault? Or perhaps the digital tokens being traded on the blockchain? Well, the truth is, it's not really an either-or question. It's about understanding the function of each one and then using them wisely together, the same way a builder uses a hammer, a saw, and a drill. Each is powerful and necessary, but only when you know how and when to use them. Today's segment number 1 is titled The Job Each Does Best. So we'll think of these as tools in your financial toolbox. First up is the US dollars. We will call them the workhorse. Dollars are the grease of the global economy. They're liquid, they're universally accepted, and they make the day-to-day world go round. They're what you're paid in, and what you pay your bills with, and what almost all purchases are backed by. So we call that the medium of exchange. They're stable in the short run, and $1 US today will still buy you something tomorrow and probably about the same amount of that something. So we call this a unit of account. But here's the problem: inflation. $1 today doesn't buy what $1 bought 10 years ago, and it certainly won't buy as much 10 years from now. In fact, according to AI, inflation may erode the US dollar by 90% over the next 100 years. So what does this all mean? Well, I believe it means that US dollars are critical for short-term safety nets and transacting business. But I believe they're terrible if left sitting too long. Idle dollars are like employees who never show up to work. They don't produce, they still have a cost even when not working, and over time, they actually become less reliable and certainly lose value. The second tool in our financial toolbox is gold, and we'll call this the ancient guardian. Gold is the old veteran of the money game. It's been trusted as a store of value for thousands of years. Empires have risen and fallen. Currencies have come and gone, but gold has remained. Gold doesn't pay a dividend and doesn't produce anything, but it shines when there's fear in the system and when people lose faith in governments, currencies, or the markets. Think of it as financial insurance. You hope you don't need it, but you're glad it's there when confidence cracks. So again, we also call this a store of value. But custody matters. Owning a gold ETF is convenient, but you don't actually hold the commodity. Buying physical gold gives you control, but then you face questions like, where do you store it? How liquid is it? And how do you sell it quickly in and emergency. And what was gold worth at the end of the year in 2025? Well, gold was up approximately 65% to around $4,300 an ounce. And while this is great for those who've owned it, gold isn't typically about this kind of growth. It's about preservation and protection. So with this kind of rise, either we do have much to be concerned about, or gold is now in a growth phase, which means it could drop some degree too. So if gold is supposed to be about preservation and protection and not growth, investors maybe should be concerned, or at least aware that it may drop some, and that would give it a negative return profile for that period of time. Thus, maybe not such a store of value for the time being. Maybe it's just considered another growth investment. Well, I suppose we shall see. And the third tool in our financial toolbox is crypto. Is crypto the new frontier of money? Well, it certainly is the newcomer. It's the disruptive upstart. It's trying to challenge the establishment. The scarcity thesis is compelling. Bitcoin, for example, has a fixed supply of 21 million coins. Unlike dollars, they can't be endlessly printed by the central bank. So this creates the potential for huge upside if adoption grows. Think supply and demand. But the flip side is extreme volatility. 1 week it's surging, the next it's crashing. Just check out the last 15 years of the annual returns of Bitcoin and you'll see what I mean. The risks of crypto include government regulation, exchange hacks, and even technology risk if the protocols change, or maybe if something better comes along. And keep in mind, there are even many altcoins besides Bitcoin too. Well, in my opinion, crypto isn't digital gold yet. It isn't a store of value or even a real medium of exchange. But I do believe many investors treat it as a technology investment, and even others a speculative hedge. That is to say, a way to bet on a new monetary system emerging for the future. So what's the key takeaway of the tools in our financial toolbox? Well, don't think competition. Don't think one or the other. Think of them as all complements. Think about having a little bit of all three. How about dollars for near-term liquidity? Gold for long-term hedging? And how about crypto for your speculative satellite investment? For me, each absolutely has a role. The question is, how do we combine them? All right, segment number 2, how to allocate without losing sleep. Okay, so how do you actually use these three together in real life? Well, here's the framework that I like to work with. First, use US dollars as your liquidity ladder, aka 12 months of expenses in your emergency fund. I've said it repeatedly, keeping 12 months of cash on hand is just a good financial planning move. And I believe cash currently still is king. So invest your dollars into short-term cash equivalents like money market funds, CDs, or T-bills. And the rates you'll find are currently higher than the current inflation rate. So you can still make a buck on your buck. This ultimately is your safety net. It covers your bills, your emergencies, and your lifestyle. Without this, if there's a shock to the system or the markets crash, you'll be forced to sell investments at the wrong time. And that's ultimately how wealth gets destroyed. Again, know what you have and know why you have it. The second part of the framework would be to use gold as your number one hedge, aka your long-term insurance hedge bucket, or consider it your long-term investment insurance policy. Even a modest and maybe appropriate allocation of 5 to 10% provides diversification and protection against big shocks like inflation spikes, currency crises, or geopolitical risks. Now, gold doesn't always work on the spot either, so you definitely need to know why you own it. Gold isn't a bond, which would typically be inversely correlated to stocks, or maybe to the dollar. As we were reminded in 2025, gold beats to its own drummer too. So again, you don't need to overload here, especially after the record year gold had in 2025. But even a small slice of gold can make a difference when things get rough. So make sure to check with your financial professional to determine how much gold may be appropriate for you. And if you don't have an investment advisor or would like just a complimentary second opinion, feel free to go to greatlakeswealth.us and leave us a message or call our office and we can try and help. And the third piece of the framework would be to use crypto as a satellite slice of a portfolio. Crypto should most likely not be the core of anyone's portfolio. It should remain a satellite. And just like there are many types of dollars besides the US dollars, obviously there's the euro and the peso, etc., there are also several other precious metals besides gold. Think silver, think copper. And when you talk about crypto, there are other cryptocurrencies besides Bitcoin. Think Ethereum, Solana, and even the meme coin, Doge. All right, when talking about Bitcoin, it should be thought of as an alternative investment, and perhaps then given the same weighting as traditional gold. And that would be a 5 to 10% allocation for most. And the reason, although thought to be way more speculative than gold, and for good reason currently, it should be treated more like a stock in terms of risk. However, it is often referred to as digital gold, and I believe it is both a technology with scarce properties, but it's also another and different hedge against the fiat currency known as the US dollar. And it's also different than the more traditional hedge that gold is considered to be. When talking about crypto, we should also consider it a rules-based investment. And this means that you decide your percent to invest ahead of time. And this is based on your financial plan and asset allocation. And once decided, you stick to it. No YOLO bets, which mean you only live once, because the headlines are hot and the investment is volatile. And in the crypto world, insiders actually use the acronym HODL, hold on for dear life, because they want to be in long term and they know it'll be a wild ride. Again, at the end of the day, speak with your financial professional or reach out to us at Great Lakes Wealth. All right, well, the rule of thumb with all of this, size it so you can sleep at night. As we always say, make a plan. And if an asset invested keeps you awake at night, you've sized it wrong. And that, my friends, is not right. Now we're on to segment 3, which we're calling the risks everyone skips. Very briefly, it's not just what you buy, it's how you hold it. With cash and the cash risk, inflation quietly erodes value. If you leave too much sitting, then you're losing purchasing power every single day. When we talk about the gold risk, we're talking storage and liquidity. Physical gold is real, but you need secure storage, and it's not always easy to sell fast. ETFs, which are known as exchange traded funds, are an option and easier to trade, but you don't directly hold the physical commodity. And when we talk about crypto and the crypto risk, how about that the SEC is still reviewing this entire asset class? Custody is everything. Exchanges can get hacked, private keys can be lost, and regulations can still be changed overnight. Cold wallets and security practices matter. It is still considered by many to be the wild, wild west. So do your homework. Be an informed investor, because strategy without risk management, well, frankly, that's just gambling. Our segment 4 is titled The Future of Money. With that, so what's next? Will the dollar always reign supreme? Well, maybe. But here are some big shifts happening. Central bank digital currencies, aka CBDCs, are on the horizon. Governments are exploring digital versions of national currencies. This could be a game changer to how we all use money all together. Also, gold demand is rising in emerging markets. Nations like China and India continue to build reserves, betting on gold as a safeguard against dollar dominance. Like I said earlier, gold was up around 65% in 2025, and that's a huge deal. But what is that telling investors? And with crypto, as currency adoption is growing with younger generations, many under 35 have decided Bitcoin isn't exotic. It's just another emerging asset class. But is it a store of value? Or is it just a speculative asset class? Bottom line, in my opinion, the future likely won't be just one winner. It will be a blended system, part US dollars, part gold, and part digital assets. And your portfolio should probably reflect this as well. In closing, I believe the future of money won't belong to just one winner. I believe dollars, gold, and crypto all have a role in an investment portfolio. But as I always say, if you fail to plan, you plan to fail. So investors should make a plan and then use all three investments together. Well, I hope today has provided some additional insight for you. And if it did, will you please go ahead and like the video and even share it with a friend? And how about subscribe to the channel if you haven't already, so we can grow and share more strategies with our community in 2026. With that, I want to thank you for tuning in. And as I always say, live your best life, be radically generous, a great big booyah to ya. And this has been another What Do We Do podcast episode, but we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.